Dow goes down. It's Tuesday, September 16th. Nope, 26th, 2023. This is Overtime. I'm your host, Chris Vecchio, joined by Ilya Spivak, and from Milan, Dylan Radigan. Gentlemen, how are you today?
How come you didn't say where Ilya is from?
Everyone knows where he's from. That
You're like,
despondent West Coast city, San Francisco.
Old news, easy.
I make it easy with a telltale bridge over my shoulder.
And I'm clearly in Chicago with this background.
Yeah, clearly. We have to do something about that. Because I think you're in New York. Anyway, call spreads, 2 words. CALLSPREADS.
Yes.
Tell them.
So it's an incredible lesson for me. I'm just going to say this not to personalize it, but I had this point of view going back to August 1st, right? Like levels are too high, headwinds, blah, blah, blah. So I'll sell call spreads. And it worked for a few weeks. Great, beautiful. Nothing, just like little. Then I decided to get bigger because it's working, which I know is always a red flag. Market goes the other way. Nvidia earnings people get all Tesla'd up for a minute. And then we're back into the decay. The point is, it's being right and being accurate in the trading of being right are 2 completely different things, which I know is sort of a statement everybody knows and everybody understands, but this is just a very explicit reminder for me these past 2 months where I have a macro point of view, levels versus outcome, right or wrong, right? And short triple Q, basically, as a point of view. And completely unsuccessful as a P&L, even though it's probably right 7 out of 10 times because sizing is wrong or timing is wrong.
My favorite quote in markets of all time that I never get tired of repeating comes from the great Ira Harris, who said in the book Inside the House of Money, which was kind of a similar interview book to the Market Wizards books. He said, if you're right at the wrong time, you're wrong. And a truer thing,
that's a mathematical fact when you have a position of any kind.
Yeah.
At the end of the day, they're like, you have less money. They're like,
Yeah. A truer sentiment, I think, has not been made.
Oh, yeah, that brings up a good point before we go into the market dynamics of today. You know, you and I worked on this product a number of years ago where we used dealing desk execution data to look at retail client positioning. And when you looked across the board, retail clients were right just as a binary, were they correct on the direction of the trade? Yes or no? We'll call it 53% of the time.
Even more.
But the problem is
53?
53. Which is better odds than playing,
anything.
Most things, better than a coin flip, right? Yeah. And the problem was that their losers were twice the size of their winners. So if your losers are going to be twice the size of your winners, you got to be right 67% of the time. And it's because they would take small profits and they would let their losers run. So sizing and scaling up and staying on top of your risk management is foundational.
It's destiny, right? Trading. I mean, you could have all the correct right answers and have no money when it's over. For that reason.
There's a big industry out there, or hopefully there used to be, and maybe now it's dead, of robotic advisors that you could plug into your retail broker, you name it, usually OTC. And the sales pitch used to be, we're right 80% of the time, 90% of the time, which might have even been true for some of them. But the problem was they still lost money because the game
didn't speak to the drawdowns.
And when it got washed out so dramatically that it didn't matter.
The picking up the pennies in front of the steamroller strategy, which probably can describe how traders felt going into the close today if they got long the market yesterday, because yesterday we saw a small bounce on Yom Kippur. Trading volumes 20% lower than they have been over the past month, which is fairly spot on the nose for the holiday, particularly
that was just me.
I
was absent, so.
Well, sorry, Mr. Well. In any event,
Happy New Year, all the same.
Thank you.
Happy New Year.
We see here that today is a rough day for the market. Dylan, I hope that after last Thursday's flip to selling put spreads, you got back onto the technical train of realism and started selling call spreads again because it has been straight down. S&P loses 1.35% today, 4319.5, with about 19 minutes left to go in the trading day. Nasdaq's off by 1.42%, 14,723. Your Russell's off by 1.03%, 1782.3, and the Dow Jones off by 1.06%, 33,911. These are all the Z3 December expiries that I'm quoting here. Ilya, I'll start off with you. It was an interesting day this morning because, as I do every morning, I benchmark all the performances of the major future contracts overnight, and I write that 5 futures article. It seemed like a pretty classic risk-off liquidity reach kind of day. Stocks are down, bonds are up, gold is down, silver's down, copper's down. The dollar and the yen are the top 2 performing currencies. By the time we make our way to the end of the session, bonds are now down across the board. Stocks are deeper into the red. Currencies are getting slammed, so to speak. I mean, when you see 0.4% lost on a currency, that's fairly meaningful given how little currency supposedly moved during the course of the year, although this year seems to be an outlier just like last year. In any event, gold and silver are still down. It is increasingly despondent. Fear is back, baby. Are we in the throes of now the top in this market? The S&P, the Nasdaq, the Russell all showing us topping signs. Is this it? Is it time to buckle up?
It seems like it. So I think we had a little bit of a different narrative coming into the U.S. session versus what happened during the U.S. session. And I think the price action, as you've just described it, kind of tells that story. And for me, the difference really is in the bonds and in the yen, and to some extent in the precious metals also. That's where you can see sort of the flavor of risk aversion that you're getting. So when you saw the yen and the dollar going up at the same time, it was largely overnight because China is melting down because its property sector hit another big bump in the road with Evergrande missing another payment. That, of course, is just one issue out of many because the property market is close to a quarter of the economy, maybe a third, depending on which estimate you look at, and there are just no good things there. And this was yet another reminder that stimulus in China is largely failing.
The latest data that I've seen shows that the Chinese property sector is 32% of their economy. Here in the United States, real estate is about 17% of ours.
There you go. So depending on year and depending on which estimate, it ranges from mid-20s to mid-30s, depending if you include things like cement production into sort of the overall pie as far as property development, construction, all of that. So that was sort of global recession news overnight. And so you saw this more classic risk aversion where the yen and the dollar were going up, bonds were a little bit better supported because yields were coming in, and the precious metal situation looked better than it does now. When we got into the U.S. session, it seemed like the flavor changed to a kind of higher for longer Fed version. And so you saw yields rise, and especially at the long end, you saw precious metals buckle. You saw the yen lose ground against the dollar in particular. Although, for example, against the likes of the pound, where I'm shorted, it continues to be down, that's a good thing. So my version of long yen exposure seems to be working, give or take, for now. The interesting difference here seems to be actually being telegraphed in the bond market, because the front end really didn't go anywhere. It was the long end that had the moves. So if you look at ZB, if you look at ZN, those bonds falling hard. But if you look at ZT, not so much. And so the messaging may increasingly be something like markets looked at the Fed, they listened to Lagarde earlier in the week, who tried to sound hawkish, whom they sold. The euro, of course, took a nice big nosedive after she said, we're going to keep rates restrictive, hawkish. Market said, right, okay, sure you are. They seem to have had the same perspective on the Fed, where the Fed said rates are going to be 5.1 next year, and they said, right, we're pricing in 4.6. All of that seemed to say the market sees this global recession, and maybe what's happening in the U.S. bond market comports with what we're seeing elsewhere, because what it's saying is rates are going to be actually lower now than in the future, because maybe that recession is getting so closer that there is a cutting cycle that the market is actually smelling, despite what central banks are saying.
Dylan, you seem to be a little bit more enthusiastic today about those call spreads. So,
no, I mean, that's a little bit, obviously.
Well, sure, but you're talking your book, obviously. But I guess the question is, at what level do you think that this is no longer the appropriate strategy, or do you not have a level in mind, right? What needs to change in this market? Because as far as I can see it today, this is now the lowest close that we've had here on the NASDAQ going back to at least June 7th.
I think everything, whether it's a financial asset, i.e. any equity or any house, is 20% overdone. So that's a Radigan. We're up a bunch. It's moved. There's no way the NASDAQ was up 40% August 1st in like 6 months or something, and those are huge companies and huge changes in enterprise value. It's just, I would say it was enthusiasm from AI and Tesla at the beginning of the year. The futurists controlled the board, and the realists have been clamoring around, myself included, housing, oil, higher, longer. And the level can't hold. And personally, based on no analysis other than a lot of movement in a short period of time, whether it's a house or Tesla stock, is 20%. To answer your question, with like a monkey, that's an intuitive. That is not an analytical statement and should not be used by anyone, maybe including me. But anyway, that's to answer your question.
I mean, but the intuition matters, right? That's gained from experience. I know years ago.
Tom Sosnoff, extremity. The thing moved. Like, what are we doing? It's crazy.
It's important. I mean, a lot of traders think that they can just, read a book or listen to a seminar or, spend a few days, months, years, 2 or 3 years in front of a chart and really learn everything they need to know about trading. And I would argue that while that can be the case for some types of traders, particularly if you're quantitatively based, you have a lot of statistics at your fingertips. Intuition matters because you're not going to see the same market cycle all the time. One of the things that I thought was so unique about the pandemic crash, at the time, and this has been one of those rolling data points that I see people reference. I have not been able to find the Bank of America survey that showed this, but like the average junior trader's lifespan on a trading desk is somewhere still around like 7 years. Which means that for people who are going into the pandemic, for example, you backdate that 7 years, you're talking about 2012, 2013, when they first got on their desk. That meant they never lived through a bear market in their lifetime.
And so missed 8 and 9, not to mention whatever it was, 99 and that goes back, and then 87. I mean, but anyway, sure.
That was one of my problems, because when I really first started trading, it's like 2005, 6, and all of a sudden, 3 years in, we see a market meltdown. And so from 2010, 11, 12, it was difficult for me to imagine a bull market, right? And it was only since I, started thinking, well, hold on a second, what are the central banks doing? What have we seen when they do quantitative easing? What's the empirical evidence behind their actions? Okay. Shut up and buy stocks, then it kind of clicked for me. Then I used that knowledge I had gained from 2010, 2011, 2012 that, just as the happenstance, I've told the story before, my daughter's born on January 28th, 2020. That's literally the first day that the pandemic arrives in the United States, the first reported COVID case in Washington. Mm-hmm. And so knowing that I'm going to be up at, night and not in front of a computer all day long, I basically close out all my positions. And so then we get to when I return back to the desk after my paternity leave, which the company is very generous. I get 10 weeks off. I come back April 7th. The market's now been down. It's been absolutely crushed. And I've seen all these interviews over the past few weeks getting ready to return for work. And Powell's saying, we're going to throw the kitchen sink. We'll do whatever it takes to save the economy. Liquidity facilities are open. And I say, wait a second, I've seen this movie before. the Fed just did this, and now we're going to have a ton of government spending as well. Oh, all in on stocks, right? You could have been a monkey throwing it on a dart at the dartboard, as you know, Dylan, from your days at CNBC, and basically pick a name out of a hat and it's going to go up. And so that was just intuition based on experience. So experience really, really does matter, because you live through enough market cycles that you go, you know what? History doesn't necessarily repeat, but it rhymes.
But also, I'm at this point, I'm smart enough to know I don't know what. I used to be like, oh, look at NVIDIA or Tesla or Apple. I'll pick a name or something really foolish. And at least this time I was like, okay, listen, the level's off. It's not coming down. It must come down. I'll just use the triple Q. It'll really, obviously it's Tesla, Apple, NVIDIA heavy, but, and the value of both of you, I think, to both me and more importantly to the audience is okay, great. Okay. Experience, you're right. Good for you, right? But the distance between being correct and having a successful trading outcome is a long road.
It is. It definitely is.
Right.
And it's a constant learning process.
It's so interesting, and I took notes when you talk to your studying, Chris, where you're like, oh, 45 days or 3 days or whatever, like self-correction in that and self-observation. And I'm very grateful, and I think the audience is lucky to have access to the discussion.
Seeing how the wheels turn is Ilya, I think, one of the more important things that we do here, right? Working through our thought process, because anyone can we give people fish, or do we want to teach them how to fish, right? We could simply shout out trade ideas and assign levels and targets and entries and stops, or we could explain the rationale for how we're getting there. So hopefully then people
can just do it and discuss it in public.
Right. Exactly. And hopefully that holds us accountable too.
Yeah. I don't think people really want, they think they want people to tell them what to buy and sell, but in reality, they don't. And the reason that they don't is because, of course, we're not standing over their shoulders 24 hours a day. So if you're sitting there, just like the thing that you were just describing, here you have to go and deal with the birth of a child. If you got the ideas in your portfolio from you or me or Dylan or whomever, what are you going to do? When you know you can't look at it, but your money is at risk and you have to make a decision. You have to know what to do yourself, or at least have some semblance of what to do and why you're doing XYZ thing. Otherwise, you're going to be left completely out there, and things are going to happen to your money over which you have no agency. That's not what you want if you're an active investor, or don't be an active investor.
I think they call that, at least up in the Adirondacks, they call that being up the river without a paddle.
Quite.
That was one of those odd movies from my childhood that I still remember.
Really?
Without a paddle? Yeah, I feel like that was. I can't even remember who was in it now. Guy who played Scooby-Doo. Again, weird things cross your mind. Experience sometimes serves to your detriment, particularly when you're talking in a camera. Gentlemen, Ilya, I want to point out what's going on here in the S&P 500. We did this math earlier on Futures Power Hour, but a head near, we'll call it 46.85, a neckline near 43.97. That's going to give you 288 points. That brings you down to the low 4100s. It's looking pretty disgusting out there for the S&P's technical setup. It's looking pretty gross out there for the NASDAQ's technical setup now, having just broken through a new swing low. Although if we want to do this from the continuous contract side, which is always good to look at both over the course of the trading day, we'll call these two different trend lines here. We'll call this, first off, the aggressive trend line that comes off of the March and the May swing lows. We break that here in August, and notice how subsequent attempts to climb back through it here at the start of September ultimately failed. And then we have the more important of the two, I would argue, not the exuberant trend line, but the one that comes in off the lows that we have in January and then again in March. This is the backbone of the entire year, basically. This is the last line of defense. We fall through there last week. Friday, we can't get back above there, even though we do, as we zoom in here, jump up to retest it and then fail. Yesterday was very meager price action at the lows in thin volume. Volume is important, I think, for traders, particularly from a technical perspective. Think of it like participation, right? it gives you confidence that there is, a desire by market participants to join in on the action. Not much of that yesterday in the rebound. Here today, volumes do come back into play, and we slink down to now a new closing low for the month. Technically not below the swing low on the continuous contract, but you're not trading the continuous contract. You're trading one of the expiries if you're here in futures. So NQZ3 does notch that move lower. That's a lower low. We have lower highs and lower lows now the last few months. It's safe to say that we're in more corrective type of price action. So Dylan, I'll bring it to you. Are call spreads, selling them, still the way to go when you think about the stock market right now?
I mean, in my opinion, obviously, I look at this from my personal perspective, from I will call a Sosnofian school, not to be self-dealing in the house, but which is price extreme and probability. And that, if you look at that basically as a big move up, and then it more or less stopped in a stalemate between the futurists and the naysayers. And then the Fed did their thing, higher longer becomes the new phrase of the new bumper sticker for a minute. And it proves the market's rational. They redid the numbers. They raised the price of money. They pulled in the equity value. I think there's lots to come down. But I don't think it's a big deal. I think if you sell your house 20% below where it is, but it tripled in the last 3 years because it's wherever, and come on. And so I don't think a 20% adjustment in stocks is alarming.
So one of the things I like about selling call spreads in this environment, granted, volatility and equity markets don't have a linear relationship. There are periods when vol stays elevated and stock prices climb. There's periods when vol is low and stock markets just drip, drip, drip and fall lower. But right now, that's not the case. The 1 month correlation between the NASDAQ and the VIX is a robust negative 0.95 right now. And because of option selling, you have theta decay on your side. So in the event that I would go out on a limb right now and saying if this relationship does hold here for the next week or two or longer, if you're selling calls in the event that there is a market rally, volatility is probably going to get sucked out of the market. And so not only do you have theta decay working for you because the implied vol in the options is also decreasing, the value of those options are coming down. So you can still make money selling call spreads, as it were, in this environment, even if vol continues to, or let's say vol does turn around and start to come off. Either way, though, if vol increases the way that it's been increasing in the relationship with stocks, it's been fairly linear. It's been negative. And so a further decline in the value of the NASDAQ, for example, is going to put that call option further out of reach. The strike will become more of a distant memory, as it were. And then you still have the decay working for you. So I like it.
But the question is okay, easy to like. I'm with you, and I appreciate the endorsement. And the reason I'm a little dismissive is not because I'm not deeply honored by your validation, but because even knowing that, it can be, and has been on a number of occasions, an unadulterated disaster because of timing and sizing.
Sure. So what kind of timeline are you looking at when you say call spreads in this market? Are you thinking end of week? 45 DTs?
I've been looking at everything from expires tomorrow to 2 months. Okay. And then I go from the strike, whatever the strike is, let's say it's at the money's 365, 375. Now it's, below 355 or something. And then based on don't do this. We need a warning letter or something.
Disclaimer.
You're asking me questions, I'll tell you, but I have I'm just, it's a point of view. And so like if I want to put one at risk to make four, but there's a 85% chance that won't pay or whatever. The market is efficient, but I decided I bet up at a good time in the sense that I went way away. Mm-hmm. So then it pays you get a bigger ratio.
Understood.
But I also have done that to be wrong, to be full clarity.
Listen, if we had 100% success trading strategy, then none of us would be sitting here.
Well, we wouldn't be talking about it in public. I'll tell you that.
No. Ilya, you've been predominantly long the risk-off trade, as it were, through the hallowed U.S. dollar. How's that de-dollarization going, folks? Which is something I tweet out every few days because, quite frankly, the notion is not only ridiculous prima facie, but it's unsubstantiated by any of the facts on the ground. Ilya, dollar is now sitting at its yearly high. Sounds like the de-dollarization isn't going so well right now. And naturally, that probably means we're going to see a swing lower tomorrow just because of the arrogance here. Nothing like the market to make a fool of me. But in any event, we're now sitting here at our highest level since November 2022. What's been noticeable about this recent rise in the dollar is it hasn't been accompanied by the part of the yield curve that typically moves FX markets.
Yes.
When we think about interest rate differentials, the technical way of thinking about this is what's known as interest rate parity. There's covered interest rate parity, there's uncovered interest rate parity. Basically, will the differences in interest rates lead you to believe that there is going to be a projected change in the value of a spot exchange rate over time? And you can use forwards, you can use spot rates, and then contemporary interest rates or interest rates pegged to a future value in time to work all this out. There's very many different methodologies because FX, unlike stocks or bonds, because there's no associated cash flows, you can't exactly assign a fair value. And then when you try to assign a fair value through something like purchasing power parity, that takes a very long time to work out, years, if not decades. If ever, right? These things can stay stretched. So I guess the point is, when we think about interest rate differentials through either our covered or uncovered interest rate parity models, we're typically looking at the 2-year yield differentials because studies have shown over time, 2-year yield differentials tend to have the most influence over spot rates. The Bank of International Settlements has done a great deal of work on this. They speak to it in their triennial survey, which comes out every 3 years, as it were.
Right.
So, Ilya, what is the deal then here? If 2-year yields, as we pulled up a few seconds ago, which I will for the sake of edifying this point of view, they haven't done much of anything here the past week, and yet the dollar has continued to charge higher. Is that one of your 4 horsemen of the apocalypse, as it were, that the dollar is able to continue to gain favor despite fundamentals seemingly not moving in its direction?
Well, so this really echoes another theory that I really hold very near and dear. It was developed by an economist called Stephen Jen, called the dollar smile theory. And I talk about this a lot. And it's this idea that the dollar is a special kind of animal. And the reason it is because it is the unequivocally dominant unit of commercial exchange for global for the global economy, and there is no alternative. So what happens typically, what the dollar smile seeks to do is to relate U.S. economic performance, to your point, to the fate of the dollar. In the classic sense, and we saw this absolutely last year, where the U.S. led other central banks in terms of rate hikes, so interest rate differentials widened in the dollar's favor. You were getting more return holding dollars than you were any other currency, and the ball was moving in the dollar's favor because the Fed was hiking faster. You saw the dollar outperform last year. On the flip side, you saw the yen underperform because it's the one major central bank where there were no rate hikes. When you started looking inside, it was generally gradients of whoever raised the most had the best performing currency. What you're seeing this year is the flip side of the dollar smile and why it's a smile and not a linear relationship. The dollar tends to do well when the U.S. is doing very well relative to others, or when the U.S. is doing poorly relative to others. And that other part of it isn't quite the environment that we're in now, but it captures a philosophical sort of thing where when the market sees the world's largest economy do poorly, what it's worried about is a downturn in growth. It's a defensive risk-off market. And in defensive risk-off markets, the dollar does well. We saw this in spades during COVID, during the 2008 crisis. Anytime we've had a major dislocation, broadly based, in markets, the dollar has done well in recent years. This is because when you get liquidation, when people run from assets, the cash of choice to cash out into is primarily the dollar because it is the most liquid. And so it is the most able to absorb a large amount of capital coming in without moving like crazy. And more importantly, to let that capital out without moving like crazy. If you were in a different kind of currency, then everybody stampeding into it to cash out would create a surge, and you better be first or you're going to buy very expensive. And on the way back out, once everybody wants to reinvest in risky assets, you better be first to sell, or else the stampede will crush the currency as the capital comes back out. The dollar is so liquid, so overwhelmingly liquid, that this is not a big concern in relative terms. It can absorb large amounts of money coming in and out because, of course, 88% of global monetary transactions are ultimately settled in dollars. Thank you, SWIFT. So as we look at this, it's not the yields that are motivating the dollar gains. It's not a yield differential in the dollar's favor. It's primarily risk aversion and capital seeking a liquid form of cash to flee into, because liquidity is, of course, in many ways, dulling of volatility, and volatility is not what you want when you're running. Now, there's an interesting split here when you look at the dollar versus different currencies. Where you are locking in rates at current levels with a significant yield differential, like 6E, like 6B, the dollar is stronger. Because increasingly, it seems like the dynamics are that.
But Ilya, am I understanding you correctly in saying that? I got two things here.
Yes.
One extremity, you're saying when the yield, when there's extreme positive or negative sentiment and data, that's both dollar positive. And when you're in between, it's slack, and it's like ducks. They run away from their mother when it's nice weather. Everybody goes on
basically.
But when there's bad weather, whether it's really sunny or really big bad weather, everybody comes back to the dollar. Is that correct?
In the sunny case, it would need to be sunny in the U.S. in particular, because you need that
relatively sunny in the U.S.
Relatively speaking, because you'd need a yield differential story.
And you're saying this is that the current dollar strength is because the U.S. is sunnier than the rest of the world, or because the rest of the world is in a fear sentiment because of perceived risk, and they're looking for a safe house?
I think it's primarily the safe haven bit, money coming out of riskier assets like stocks, like other currencies, and
like euros.
And going into cash. Going into cash, and the dollar is the most liquid form of cash, which means it is the least jumpy. So if you're going to cash out and park it somewhere, this is where you're likely to go. And this has been the example.
Better than a rupee.
Exactly. And to your point, I think it's both, because when you look at what these dynamics suggest, the euro, for example, is doing much worse against the dollar than, say, the Australian dollar at this time, and, say, the Canadian dollar at this time. And the reason, I think, is if the markets look at this and say, well, why are 2-year yields not moving, but longer-term yields are? That seems to be the kind of steepening of the yield curve that says rates will be higher in the future than now, which means there's going to be some sort of turmoil.
But that could be because either growth is accelerating and the futurists are winning, and thus demand for capital is up, and the rates are rising as evidence of strength.
Yes.
Or rates are up because inflation, because cross-border, because reshoring, because. And my question for you is, which future do you believe the market is predicting?
I think when you look at the S&P, you see it. If we were looking at the triumph of sunny days ahead, we would not be seeing stock markets coming apart. So when you put
sometimes you have to drop back and punt, even if you win the game.
That's right. But when you put the price action together and you say, well, these are the things that are happening at the same time. The long end is higher and the short end is stuck. And stocks are falling. And gold is holding up okay, whereas it should really be getting hosed because rates are higher. What's going on? What does this combination of things tell us? And I think what it tells us is an expectation that rates probably won't go much higher in the near term because of some sort of consternation, that they will have to go higher later, which again implies that there's some sort of a downturn coming. So if we are looking at then a freezing of rates where they are now for a while across the world because central banks have become spooked, and we've heard this now from 5 or 6 central banks, including the Fed, over the course of the past month, be it ECB, BOE, RBA, BOC. You look at all of that and you say, okay, if we freeze rates here, where are the differentials greatest? Well, they're greatest between the dollar. Well, where are the dollar differentials greatest, I should say? They're greatest between the dollar and euro and pound and yen, and they're much smaller between the dollar and the Aussie and the Canadian dollar. So it seems to be both. It's risk aversion, and then on top of that, the relative strength of the dollar across various currencies, that seems to be defined by a yield advantage that the dollar is locking in here if everybody is going to stop in a coordinated way.
Chris, storms or sun?
In a very near-term path, it feels like the storm clouds are...
No. Why do you think rates are adjusting higher at the long end in anticipation of problems or prosperity?
Can it be both? I think it can be both.
Of course it can be both. I think that's probably the right answer, right? It's all in the, it's like how much of which.
It's not just that the Fed cut to rates or rate cuts out of their projections for next year. It's the fact that if you look to their longer term interest rate forecast, that also was boosted. It's almost to suggest that we're not going anywhere close to a 2% or 1% Fed funds rate anytime again soon. We settle, we're probably going to settle closer to 3.5% when the Fed gets to its rate cuts. And that's predicated on this belief that R star, which is the neutral rate of growth, something that you can't observe in real time. You can only estimate it, which is why Powell says things like we're guided by stars or navigating by stars underneath cloudy skies. We know what we should be looking for, but we don't know exactly where it is. They think that the natural rate of growth, the neutral rate of growth, has moved up. And so all of a sudden, if they're saying that the neutral rate of growth has moved up, well, where are growth expectations embedded in the part of the yield curve at the long end? Is ZB and UB, which have been hit hardest since the Fed's meeting last week. The market doesn't seem any convinced whatsoever that the Fed is going to be raising rates and keep them at a higher level. That's why I pulled up the SR3 Z4 contract earlier, and we go to SR3 Z4. There we go. New hands. The way that we look at this here, and should it load, there we go, 95.35, we can infer the year-end Fed funds rate by using this contract. How do we do so? We look to the y-axis here. It's going to give us a number, in this case, 95.35. We take that from 100. And so we're thinking that there's going to be a 4.65% Fed funds rate at the end of next year. Hold on. The Fed told us that they saw the year-end rate moving up from 4.6 to 5.1%. And the market is telling us, no, not going to happen. And it's because there is this circuitous motion of, by keeping rates tighter for longer in the short term, it reduces credit growth, loan demand longer term, which has the implicit turning of the wheel. The ratchet then spins to reduce economic growth down the line, because if I can't take out a loan today, that's a business that can't grow over the next 6 months, which means 6 months from now, the taxes that the government would have received are lower because that business isn't there. That means that there are people who could have been in the workforce 6 months from now that will not have jobs, which means consumer spending will be lower in 6 months from now, et cetera, et cetera. The ratchet keeps turning and turning and turning. And you think about the storm clouds in the very near-term horizon, a government shutdown, bad for the economy. Markets really shouldn't care about it whatsoever. We pulled up the stats on Futures Power Hour today. Average government shutdown lasts for 9.5 days. There's a 0.3% return in the S&P 500 during government shutdowns going back to 1976. The median return for the S&P 500 is 0.3%. There's really no reason to be concerned about it. But for the economy, government spending is a positive coefficient in our GDP equation. Less government spending, less growth. UAW strikes. potentially stagflationary. Less new cars, or fewer new cars.
Oil prices
going up, right? But production going down. That's going to reduce growth.
Residential and doomed commercial loans.
Commercial real estate is an absolute nightmare right now. And I have some friends who work in commercial real estate, and they're like, we are just trying to get what we can while the getting's good. And it's not that good. So
yeah, I was looking at a study of folks employed in real estate, sort of the employed in real estate component of non-farm payrolls. There's a stampede out of the sector because there's just nothing to do.
No deals, because no one wants to take the markdown, so they just hold the book at whatever number they think and bide their time.
And so when I think, what's the S&P 500? What are the bond markets pricing in right now? I mean, the near-term path is definitely shaping up to be a little bit worse off. And granted, Ilya, I think I've been fairly consistent about this. Third quarter is going to be good. Most of it's behind us at this point in time. In fact, there's 4 days left. So for the ship to turn dramatically from the Fed's, or at least the Atlanta Fed's 4.9% estimate for third quarter growth, could it go down? Yeah. But we're probably looking at 2.5%, 3% growth in real terms as a floor for the third quarter. But when you look into the fourth quarter, all of a sudden, death by 1,000 paper cuts, that's legitimately something that's happening. These are all little shocks that are hitting the economy at the same time. I kind of like it.
But the labor market is tight
for now.
Yeah, we have so much. We have the best leverage in decades for the auto workers, with the most effective strategy, coordinated, like all the sort of digitized strategery of this one and that one. So they're getting much more effective. The writers at least were able to fend off the AI doppelganger, magic. Like Ilya has to agree to let you use Ilya to say things about money in public, whereas they were talking about taking a full AI lift on whoever, Tom Cruise. I mean, it's crazy. I mean, and so my point is just the labor market's tight, and and that forgives a lot of sins.
Yeah. I think to the Fed's point that they keep making over and over and over and over and over and over again, they can have but limited agency over pockets of inflation that are stuck in the service sector, because a lot of them are there because of illiquidity, like housing, like let's say cars.
Artificial supply constraint because of a refusal to transact. Or a disincentive to transact.
That's right, because of the Fed's own actions, because of the rates. And so one of the places where they can have agency is in this lingering mismatch to the tune of about 3 million workers in supply and demand for labor. To your point, it's still very tight. Obviously, you're not going to manufacture supply in any kind of a short-term sense or even a medium-term sense. And even if you wanted to have a massive immigration effort, there is no evidence, at least looking at Canada, which is attempting this, that you could do it. Obviously, the scale of the issue in Canada is much smaller. They have a much smaller population. But even there, you have a wildly popular effort, loudly endorsed by voters, to go and get more immigrants to fill some of these labor market gaps. And they're not finding the right skills match to really get that done. So
look after their latest accusations against India, filling some of those skills gaps.
There you go. So
listen, the Canadians are like a sibling. Like the Canadians are like a middle child. Like the Canadians just get to come along for the ride. Like we have no choice. It's the security. They're nice. They talk, whatever. Like Mexico and the United States are really well positioned for the long term demographically.
Yes.
And then Canada's just going to kind of be brought for the ride, whether they like it or not.
I mean, 80% plus of Canadian exports come to the U.S., and most of the population lives within a stone's throw of the U.S. border. So
I don't know if this is true, but I was in Toronto and had one person tell me, who spoke with a few people actually, that there are enough people inside the 4 highways of Toronto that if everybody inside the 4 highways voted, they could pick the prime minister.
Canadian politics is a
It's a fun time.
It's an awful joke right now. But to just put the Canadian economy in context, it has twice the population of the state of New York, and New York has a GDP of 2.05 trillion. Canada has a GDP of 1.98 trillion per most recently available data. So.
But Canada's like a sleeper Saudi Arabia. Like Norway and Canada get away with being like, everybody thinks of the oil people, it's like hot and Saudi or Russian or Venezuela or Texas.
That's right.
They're like, oh, Mr. Texas or Mr. California. No. There's some very wealthy oil nations that are in the deep north, and Canada is one of them.
Yeah.
And they get away with a lot. It forgives a lot of sins in Canada.
That's right. Well, and so to that point, right, the Fed can't manufacture supply. So to bring supply and demand into balance, it has to hurt demand in the labor market. So goes their theory. And so that's how they're going to attempt to unstick the inflation. And
I would say to the Fed, okay, well, GM's going to go, they're looking for a 40% raise for the auto workers. That's what I tell them. Like, then go, I'm going to raise the price. I mean, that's what's happening.
Right.
People have leverage.
They will absolutely pass the cost on to consumers, plain and simple.
Haven't they already?
They have. The average cost of an automobile in the country is up like 20% the last
cars are crazy
6 years, and workers' wages are up 4%, which I suppose the big talking point today is that we have the two leading contenders. I mean, outside of like the FTC suing Amazon for antitrust issues, which you can make a case they're monopoly, or Target closing down more stores, although Target has other problems besides. What's the name of the term? Shrink, as they call it, shrinkage. The
technical term for shipment of widgets is shrinkage.
Right, so shrinkage. But Target has a huge overstocked inventory. But I mean, the big news for what's happening with these UAW strikes is that President Biden picketed with the workers today. It's probably the most pro-labor thing a president has done since Teddy Roosevelt invited striking coal workers to the White House in 1906. I think 1908, maybe off by a few years. I tweeted about it the other day. President Trump is also going to Michigan to speak to workers, although he's speaking to non-unionized workers who aren't affected by the UAW strike. But it's the images that people care about, right? Getting in front of workers and talking. Counter-programming to tomorrow night's totally unimportant RNC debate, as it were. But doesn't this just go to show that you now have politicians like doing something that hasn't been done in over a century to cater to these labor groups?
I'd say that's evidence that labor has more power now than they've had in decades.
I would agree with that assessment completely. I think that's spot on, exactly what's going on. And COVID has, of course, made that much more dramatic. It would have been happening anyway because of the demographic changes happening in labor markets, not just in the U.S., but everywhere, with the exit of the baby boomers really heating up. With COVID, that process got such a dramatic accelerant that it's really all coming to a head, and is probably going to stay here and be a source of inflation to some extent for a while, because these demographic changes aren't going away soon. And it's probably, to your point, Dylan, going to be much more digestible in a place where those demographic issues are less bad, like the U.S.,
Mexico.
And Mexico, and of course our access to Mexico. We have a free trade agreement with them.
My money's on America and Mexico for the next 50 years. I'll take it over Russia, over China, over South America.
I agree emphatically.
Can I provide some perspective on the situation, why this is not going to be a problem that goes away in the next year or perhaps 5 or even 10? When we have populism enter the political arena in the United States in the 1930s, you're at that time at a high point based on the available data.
Hang on. You have me at 1906 coal workers. You just bumped to the 1930s. What happened between is there anything?
Nothing important happened. Titanic, I guess.
So you're saying labor.
Black Sox scandal.
You're saying labor moved the piece on the chessboard in 06 with a bigger piece of the pie. And that's trust, Rockefeller, all the things, the famous trust buzz, all that jazz.
And yet not much changes in terms of labor's share of GDP. If you look at wages of GDP or corporate profits as percent of GDP from the early 1900s into the 1930s. But there's this bubbling movement where corporate profits are growing as a percent of GDP and wages are not. And then populism it comes to birth. You have the 1929 crash, you have the Great Depression, and so all of a sudden there's this reshaping of the economy. FDR comes into power. From the 1930s through the mid 1970s, labor's share of GDP continues to increase, and corporate profits as a percent of GDP decrease. And they decrease for such a long time that you reach a tipping point in the 1970s where the relationship flips. And since the 1970s, labor share of GDP has been going down.
I would say it's since Reagan fired the air traffic.
Well, that's part of it.
I would say that was the next move after 06. 06 is the uptick, and then Reagan said, and the air traffic situation.
Sure.
And I think that this year is a move back again. Sorry to interrupt.
Exactly the point I'm making. It took
tone setting exercises. Absolutely.
It took 40, 50 years. I'll say 1930, just for the sake of my 40 to 50 years argument. So it takes from 1930 to, we'll call it 1980, for labor to gain their share and for corporate interests to lose their share. And then starting in 1980, we'll call it, until effectively now, corporate profits as a percent of GDP have been going back up and labor share of GDP have been going back down. And now what are we seeing? We perhaps have reached that generational tipping point where populism is back in vogue. You could call the last 40 or 50 years elitism, if you will. And now we're on the other side of this. And if American history is any sort of guide, maybe technology compresses the timeline a little bit. But if history is any sort of guide here, this is not going to be a problem that goes away because of one labor deal between UAW and their employers. It's going to be something that's across industries. We've seen this with UPS. We've seen it now with the Writers Guild and in Hollywood. That contract's 3 years long?
The railroad went sideways earlier this last December.
Yeah, and railroads in a really unique situation because of their place in the national security apparatus. But even so, we now have the highest, a number of work days interrupted by strikes going back to 2000, and we're not done with the year yet, right? So we're talking about something that is a really significant impulse through American society. Demographics are only going to get worse from here, as Ilya likes to point out all the time. Luckily, we have some things in our favor, like immigration, people knocking on our doors to continue to come in, a growing population south of us in Mexico, where we continue to draw immigration from. At the end of the day, whatever we see in the headlines the next few days, weeks, about Ford, about GM, about Stellantis, this is the tip of the iceberg. This is only getting started. And so inflation being stickier, why are interest rates at the long end moving up? The dynamics of the labor market absolutely have something to do with this. And there's the simple,
now my friend Tom, my friend Tom would argue increasing the stake for labor makes the enterprise more valuable over time.
Oh, I would agree, actually. 100% agree.
I would agree.
100% agree.
Would you buy the automakers in the middle of this mess?
Absolutely not.
Because of the why?
I don't think they have good business models at the end of the day. And I think something that's going to increase their overhead costs significantly, like forget what they do. This is simply balance sheet numbers. Do they have big moats around their company, right? Are they growth stocks? Sure, they may pay some dividends out. Are these companies really going to benefit? There's a lot of congestion in the auto market.
Do these companies have management that can actually
make
a leap with the resources at hand in a way that moves to the future?
I think Ford does, only because they have, nepotistic, but it's still in the family, right? Like they have they're building the name for the sake of keeping the family's legacy going.
Meaning they can take bigger risks because there's more cover for the CEO because of the family relationship.
I think so. And in fact, the CEO of Ford has been directly involved with the UAW, and which of the three automakers is currently seeing the least impact from strikes right now?
But you wouldn't buy Ford stock
I will trade Ford stock. I will not own Ford stock.
Because of the reasons you described. What about Tesla?
I have serious FOMO from Tesla this year because what was it, 101.83 the low for the year, and my buy orders went at 100. Sometimes when you pinch pennies, The pennies pinch back.
But is Tesla the same company as Ford? I mean, obviously not. But are they even in the same business?
I think the way that you look at the valuations,
it's certainly not moving that way.
They haven't traded that way. The valuations certainly don't speak to that.
I agree. I mean, I think the enterprise value tells you it's not the same thing.
But gentlemen, we need to wrap this up because we are out of time here on Overtime. I don't want to step on Ilya's toes for Macro Money. So with that said, to get more of Ilya, you of course can watch Macro Money every Monday through Thursday, 5:30 Eastern, 4:30 Central Time. He's also on First Call with Tom and Tony Sunday evenings, 5:55 Eastern, 4:55 Central. You can follow me, Futures Power Hour, Monday through Friday, 1 p.m. Eastern, 12 Central Time. Let Me Explain Tuesday mornings, 9:40 a.m. Eastern, 8:40 a.m. Central. Today we talked about the relationship between bond yields and stocks and why rising bond yields make stocks relatively less appealing. Also, why is gold vol now lower than that of bonds? That's never happened before. Of course, Ilya joins me on Fridays for Futures Power Hour as the co-host. Dylan Radigan, Truth or Skepticism with Tom, at 2 p.m. Eastern, 1 p.m. Central Time on Wednesdays. He's here with us on Overtime when he can join us Monday through Thursdays. I believe he'll be back on Thursday this week, Mr. Radigan. Is that correct?
No, I'll be back tomorrow, and then I'm flying Thursday, so I'll miss you guys Thursday. So I'll get today and tomorrow.
Back tomorrow, flying Thursday. Until then, though, hope everyone has a good rest of your evening. Good luck trading. Up next, Macro Money with the man himself, Ilya Spivak.